Welcome back, traders and investors. We have Victor Ricciardi on the line. He is an assistant professor of finance management at Goucher College and co-author of Investor Behavior. Victor, how you doing this morning?
I'm doing great. How are you doing?
I'm good. I'm good. So the investor behavior has been buy, buy, buy. And what do you think about that? Can that psychology continue in this market?
I think if we keep in a good mood, that essentially the research shows if we're in a good mood, we tend to have a higher risk tolerance, and then we keep on buying, buying, and buying. Versus if we're in a bad mood or if the market turns, then we have a lower risk aversion, and then we sell, sell, sell.
What about like herd mentality, Victor? Like it seems like once the ball gets rolling in one direction, some of these stocks they just keep going and going and going. We just even watched this GoPro. It just had its IPO there 3 days ago at $28. The stock, as we speak right now, is up another $4 here in the pre-market, almost trading at 43.90. Do you think the herd mentality has a lot to play in this market?
Well, herd behavior shows, especially related to investor sentiment, within a 6 to 12 month, there's research that shows in a 6 to 12 month period or shorter periods, you can, if you're following the market, you can make higher returns in general.
So by following the herd, it seems to work in your favor, you're saying?
Yes, some research in the book that shows that. But again, as human beings, we have a problem of when to actually sell and get out. That's the other thing.
Timing. Right, because it's all timing, because eventually when the herd decides to go the other way, you better be quick to identify it, because the stocks can obviously give back a lot of the gains in a hurry too.
Exactly. I mean, for example, even our subconscious mind will affect our decision making. So, for example, if we see a depressing commercial, or for example, if we're in a bad mood. So, for example, I'm a Mets fan. They lost last night, and I'm not buying stocks today because I'm in a bad mood.
Oh.
Are you shorting stocks? Are you in that bad of a mood?
I don't know. Maybe I was short stocks, or maybe I should short the Met game tonight.
Well, we're Tigers fans here in Detroit, so we're actually, I guess me and Joel, that's why we're both bullish today here, because we had a walk-off grand slam last night.
Oh, there you go. If you're in Detroit, I guess you're very happy right now.
It's funny you talk about that investor behavior and how it really translates. I know if if I go to a restaurant or I go to a hotel and I get bad service or a bad meal, I'm very apt to short that stock the next time I'm at a trading desk. Do you think that people really do react that quickly to things that happen on a day-to-day basis, or is it more of accumulation of things over time?
Well, I think each of us acts differently in different situations, so that's where actually in the book there are even a couple chapters on trading psychology, where I think if you do a little bit of self-diagnosis, where if you use things that happened in the past to actually try to stick with those things and have a disciplined strategy. The problem is most of the time we don't, or we repeat our mistakes. So that's kind of how we have to realize that we can act on our emotions to make trades, and that may lead to success, or negative emotions for many of us, such as me. I realize I need to have a rational, disciplined strategy. So I think we kind of have to self-diagnose ourselves, figure out what personality type we are, and then based on that, some of us are able to trade on emotion.
You bring up a very good point here, and people are in the markets for a long time, and they book a lot of profits, and everything's great when the market's going up. But then you have these wipeouts in the market, and the market comes crashing down, and everyone complains. Well, now I'm down on my investments. How can people, what should they do? You're talking about the psychology of financial planning and investing. How can people, do you suggest they just slowly sell out of their positions and take profits? Or, how can people get over that? Because, you'll know it. Eventually it's going to happen again, and then people are going to be complaining. How can people get around that?
Well, it's something in behavioral finance called mental accounting, which some people view as a bad decision making. So I kind of use that as if I'm thinking in terms of myself, I use that as an advantage. So mental accounting is I essentially put a couple of my different accounts into mental buckets. So 90% of my mental bucket is retirement accounts, in which I manage my risk tolerance, with my asset allocation. And the key thing that I see is that people are typically status quo investors, meaning they don't make any adjustments to their account. So one thing that I realize that most people don't do is I rebalance in that retirement account once a year. So in upper markets or in bull markets, I take some money off the table. Lower markets or in declining markets where I don't want to invest in stocks, I put money into stocks. And then on the other 10% of my portfolio, I just have play money in which if I want to buy a stock in an IRA account, that helps me get over my trading mentality. Or I just go to the track every once in a while.
Oh, what track?
Well, I used to go to Belmont. Now I live in Maryland, but I haven't been going as much. But I think I need to go in the short term soon.
I love Belmont. That's a great track.
Yeah, Belmont's a great place.
I think I try to do the same thing. Like I'm a day trader by nature. I've been a prop trader with Bright Trading there out of Las Vegas for 15 years. So I have this like trader mentality and the scalper blood in me, I always say. But I used to try to, do my investments too, but managing them in a similar account. But what I had to eventually do was get a different account because that trader blood in me always makes me trade out of the positions if I'm looking at it every day. So I've got this long-term investment account in a retail brokerage where I just try not to even log into it for weeks on end so that I don't trade out of this stuff. Do you think it is important to like separate your trading and your investing?
Yes, and the book, for example, has a chapter on different behavioral finance trading strategies and investing. So typically, the author who wrote the chapter on trading strategies separates anything less than a year is a trading strategy. Anything that's greater than a year is an investing strategy. And then he talks about, for example, things like momentum, earning surprises, something which hedge funds are looking at Form 13 filings as another indicator of a way to find potential buying opportunities.
Getting a good question from the chat from Hurt Capital. He's asking, do you recommend using performance coaches to overcome these psychological obstacles?
Most definitely. I can see that there's 3 or 4 people who wrote 2 chapters on coaching, and they actually do this. They have a couple of case analysis in which they seem to do a very good job of and have nice firms in which they do this. I have a colleague who told me because of the financial crisis, the psychology or therapists realized rather than bill people for general psychological normalities, they can charge them $200 an hour. They call themselves money therapists, and they charge them $1,000 an hour. Mm. So I mean, it's kind of there's such a wonderful new array of financial therapy, trading psychology, financial counseling, and so many of us, I think, suffer from a wide range of biases and emotional issues.
Yeah, and even with social media, the impact that has on your emotions too, because you can look and you can get 10 different opinions on your stock. It seems like every minute if you want, if you're looking at a really popular stock there. How do you like not let all the social media and all the other instant information that we get affect your decision making?
Well, again, I don't see anything wrong with using that as an indicator, but do your due diligence. If you have a certain investment philosophy like fundamental analysis, and if you look at P ratios and things like that, I think it's okay to use those as indicators. I mean, if Carl Icahn just posts something to his Twitter account that he bought a position, many people follow that herd. I don't think that's necessarily good due diligence, whether you're a trader or investor. I think you can use that as an initial indicator to identify an investment, but then whatever philosophy, whether it's technical analysis, using charts, back it up with some other something to back it in terms of go with your investing philosophy to make sure it meets your standards of buying and selling a stock.
Okay, to close things out here, Victor, everybody's in a great mood. Buy, 4th of July holiday coming up here. Markets on a roll. Is it going to be something from the Fed that's going to change the psychology? Is it going to be, I know it's hard, I'm not making you have a firm prediction here, but you have the psychology now. What's going to change it?
I mean, it can be something, even just understanding past history, something like oil prices. I mean, if this issue in the Middle East continues, for example, at some point especially when people come back from Labor Day many times. They don't pay attention over summer. I think once everybody comes back after the holidays, that's always a good indicator just to be careful and maybe take some money off the table.
Okay, Victor Ricciardi, Assistant Professor of Finance Management at Goucher College and co-author of Investor Behavior, The Psychology of Financial Planning and Investing. Victor, thanks for coming on, and we'd like to have you on again.
Anytime. Thanks for having me.